Hello traders, this is Rich from TradeSight. This is the market preview for the upcoming session. This is going to be for Tuesday, May 14th, 2013. Today we had a day where we came back and started the week with a gap down. Bull market, you really want to give the market a chance to close that gap on a Monday with a retail rush coming in, and also the funds putting new money for the week to work. And we did in fact close the gaps and then proceeded to push higher. The push higher, though, did not hold, and we kind of filled back in here. So what we really did is we kind of went out, in the general area of what the settlements were from Friday. The S&Ps were essentially unchanged on the day. Nasdaq was up 5 handles, and the Dow was down 25. So essentially, it was kind of a non-event by the end of the day. The advanced declines were not particularly good. We're negative on both sides. New York trend closed at 0.92, and the VIX was essentially unchanged. The only real feature that the market presented us with internally was that the put-call ratio moved back down a little bit closer towards that climactic reading. We'll take a look at that chart in a bit. But first, let's take a look at the ES futures and the NQs, and then we'll move on to what the market's doing internally. Okay, so here are the ES futures in daily bars. You can see we really didn't make too much progress today. It was a little bit of an up day. We are still kind of gripped within the general area of that 8-ace Murray Math level at 1625. Note that as of today, we're going to be 8 days up. One more day to the upside here. We'll complete this 9-bar run to the upside. What that'll leave us with is a 913.9. This will be 9 bars to the upside here in the setup phase. Those are the green numbers, and then 1 through 13 and the red numbers. That's our countdown phase, and then a fresh reinforcing 1 through 9 to the upside. So here's your 9, and then your 13, and then your 9. Oftentimes that will produce a reaction to the downside. This 1 through 13 was really too flat and had so little extension to the upside that when this was developing, we weren't really expecting it to turn the market, but maybe just hold it. It didn't even do that, in fact, but it did pivot back to the upside almost immediately after that. Only held it in check for a few candles, which is really nothing at all. So we're very, very close to printing 9 bars up, and if we do so, then we're going to have to be on guard for either some sideways or probably more likely a little bit of a corrective activity. We're starting to get some more distance here above the 50 DMA. This is about as stretched as we've been all year. Even this aggressive impulse here in January wasn't quite this extended. And also to note the distance here above the 200, that's the one that's really starting to widen out. So very subtly, the market is starting to get a little bit overbought, at least by the naked eye. But the internals are the ones that really, the internal readings are the ones that'll really be the deciding factor. We'll look at those in a bit. Here's a look at the NQ futures. We're again in the area of 8-ace on this chart too. This one is 29.68 3/4. We did make a new high in the move and also a new high close. MACD is starting to climb here pretty aggressively. This has a little different setup though. We don't have the 913.9. We've got our 9 setup here, and now we're getting into the countdown phase, and we're only on day 6 of the required 13 for an exhaustion warning. So we do have some more room to run to the upside if they want to keep pushing. If we do push higher, the plus 1-ace level at 3007 will be the next overhead level to the downside. There's really not much that really means anything. It's just all going to be little layered support here. They'll be more visible on the 65-minute chart. And then big support's going to be where the 10 EMA intersects with the 7-ace level, and also the gap window here from that payroll number. All right, we just talked about the total put-call ratio being fairly low, came in at 0.58, kind of matching those very low numbers that we got just last week, but we didn't really get that super decisive 0.5 reading. So let's be on guard for that. If we do get that 0.5 reading, and that's also coincident with 9 bars up in the seeker, completing that 913.9, then we're probably going to have a pretty good reaction to the downside. Usually, if you get that climactic reading in the put-call ratio at 0.5 in that area or lower, usually get a very, very sharp move, almost like a price shock, within 72 hours of recording that that reversal threshold move in the put call ratio. So let's definitely stay on top of that one. All right, here's a look at the 10-day trend. That's the upper chart. The lower chart is just the S&P. The 10-day trend is still in that relatively neutral area, right around 1. So this, while the put call ratio is close to being climactic, this is nowhere near climactic yet. We really need to get to that 0.85 level down here to get that really nice overbought condition to support a real reversal to the downside. We don't have that just yet. So there's more room in the tank here on the upside if they want to use it. Here's a look at the S&P divided by the TLT. This is one of our key risk-on, risk-off metrics. You can see that we did have this corrective activity when we lost this upward trend channel. Okay, we've since kind of pivoted here and reclaimed that. We did make a breakout here recently to a new high in favor of stocks over bonds, and we did climb today, even though the market did very little because the bonds were fairly weak again today as well. So we've gotten back up into this lower boundary of the prior trend channel that we broke down from. So we're starting to get into an area where we're probably going to find some better resistance as far as gas in the tank for putting risk on. And note the impulses that we've had this year. This is the first impulse this year. We span the width of the box. Then we kind of just we're grinding to the upside here in a fairly organized manner. This is your trending phase. Then we had a correction down to the bottom of the trend channel. Then we had another impulse back to the upside, and then we had this corrective trend back down here. Okay, the impulses are generally fairly linear, and the trends are back and forth. Now we've pivoted back to the upside again and had a very aggressive impulse to the upside, and this impulse to the upside as far as risk on, risk off is actually bigger and more impulsive than the other two that we've had as far as amplitude goes. So definitely be aware of that. This could be something that would also line up with that climactic put call reading that could really give the market fits if we roll to the down. All right, as far as the individual sectors go today, here's our multi-comparison chart. The best sector on the day, I think by far, was the BTK. The BTK pushed out to new highs. You can see how it's really just pulling away from the other averages here. The SOX was lower on the day. The financials had an okay day, but they really didn't do much to better their previous high. It's the BTK that was really trading well. And you can see down here that the gold names and the other precious metal stocks were a source of funds for the rotation here into equities to buoy the market as much as they did today. Okay, now let's take a look at some of the individual sectors. Here's the BTK that tracks the biotechs. We did push above that 2000 level, which is the 8-ace level on the Murray Math box. So we got up to there on Friday and then followed through today. And today we got up to a very key area. This magenta colored line is the risk level, or the stop loss, if you will, from this exhaustion warning from the seeker here. This 1 through 13 will print this magenta risk level. The risk level is the 13 candle, which is this one, with the range doubled. So now with this risk level set, the risk level is a mathematical calculation. It represents the maximum impulse above and beyond the 13 exhaustion that you would expect. So this is actually a very important level on the chart that a lot of other folks won't have available to them. It's around 2032. If we close above that and follow through by at least one tick to the upside after the close above it, then we'll break that risk level and then potentially put even this 2-ace level in play, the plus 2-ace level here at 2125. So the risk level is really important. It's kind of an in-between level, and definitely have that handy. Here's a look at the SOX. The SOX had a pretty weak day. It was definitely weaker than the overall broad market, and certainly weaker than the NDX. Back down here, there's really not a lot of support until it gets back down into this 5-ace area, which is also roughly the 10 EMA, which is on the rise. So about 454.5, maybe 455 will be support for the SOX if we do continue to kind of roll down here and consolidate this push. Now just keep in mind, this is the breakaway gap that started this whole thing. This is a 3-ace. Now I've traveled all the way almost up to 6-ace. So oftentimes with harmonics, with the going that far could be a place to pause and take a breath. Switching the chart to the XAU. The XAU basically still range bound here. Hasn't been able to break above the recent high here which stopped it, which was this 1/8 level, and obviously key support at this 100 area. Were some camouflage buys this morning on some of the names. So take a peek at the pre-market preview for the individual stocks off the scans. That should definitely be worth your while. And finally, here's the BKX. The BKX traded a little bit better than the overall market. Did make a new high on the move and basically matched the previous closing high here. Got overhead here at 59.38. We're getting pretty deep into the count here. We're 7 bars up now. If we get 8 or 9 in the next couple of days, that'll also be something that'll kind of slow the ascent down and give the market a reason to catch its breath here. Okay, and finally, I want to talk about oil. Oil was really weak today. Commodities in general were fairly weak. Gold was soft. But what I want to point out here is that the OSX, which is the red line here, actually broke out today out of this trading range that it had been in. Oil was weak on the day. I would expect oil tomorrow to be a little bit firmer unless there's some news to keep that from happening. But left in and of itself, we should see some better strength in oil. Now keep in mind here, here's the key. The oil producing stocks generally lead the actual commodity. So we do have an attempt at a breakout here in the OSX, which is the oil services. Now if this follows through, that would definitely get me interested in starting to look at the oil futures or the USO ETF if you prefer on the long side, because if the oil stocks break out, usually the breakout in the crude itself or the underlying commodity is not far behind it. So just keep that in mind going forward. All right, folks, as always, thanks for listening, and this has been Rich for TradeSight.